Oh my God, we're live. How you doing? Good to see you. This is the 0 Days to Expiration podcast, shown on YouTube and X simulcast, and shown every Monday, Tuesday, and Wednesday of each week. And I provide a presentation. Today we'll go through our standard strategy and what its primary features are and why we trade that way, and how we extend that to gamma scalping. Originally, or I should say the traditional trade desk way or institutional way of gamma scalping is something that a lot of people have tried as a retail trader, but they find that it's not something that is easily pulled off, and mostly because you don't have the kind of account that a trade desk has. You don't have the same kind of commission structure and so forth. And they're really playing for small gains, but consistent gains over the course of a day. And while that seems attractive for a retail trader, it's virtually impossible to pull off. And I wouldn't recommend it. And what I put together was a comparison of the two different types of methodologies. My methodology is very different. It's still taking advantage of gamma scalping, but I look at it from the point of view as an edge trade, not something that you do every day like you would in a trade desk or an institutional way, which is, quite frankly, impractical for the average retail trader. My way follows the same precepts of our fly on the wall or our standard out-of-the-money butterfly trade that we take in the morning, but instead we wait for an advantage to do that later in the afternoon. When I say it's an edge case trade, it is particularly geared towards lower volatility environments, much like what we're heading into now. As the market is moving up, volatility is dropping, and premium decay is increasing. It's rapidly increasing. And that's what we're looking for, because on that rapid increase in premium decay presents our opportunity later in the afternoon. I'll provide a full presentation that you can download and develop your own strategy around that. That's really my intent. And also to tell you that we practice this sort of thing every day in our fly on the wall service, which is an extension of our 0DTE service. So let me explain. We have a 0-DTE.com, and that is my coaching service. And Fly on the Wall is our sort of an extension of that, because we built a tool around that service. So it's basically the same 0DTE stuff that we do. And in fact, it's the same Discord. Everything's the same customers and all that. But we've created this website called flyonthewall.ai. And there you can join our service by looking at the trial called the Observer Tier. It's a 4-week trial. And you can join the service, the Discord, and take advantage of the tool and all of our methods. And there's an incredible amount of educational material around all of this. I'm trying to present all that in the morning here so you can see the efficacy of what we do. So in general, what we're trying to do is take advantage of the 0DTE event and make it friendly for a retail trader. And our primary goal is to help you be consistently profitable, independent, and trade at a pro level without taking on the same kind of pro level caveats that aren't available to a retail trader, but using the same principles, and that is super small risk, large potential profit. And the way we do that generally is we place an out-of-the-money butterfly to the market. We right-size it based on the level of volatility. And if you want to learn more about why we right-size it, or how we do it, or how that actually affects the trade, check out some of our earlier presentations. Over the past month or so, I've already produced, I think, maybe 15 different presentations. And they're all super impactful, going over the strategy in great detail, the underlying technology and situation that we're trying to take advantage of. All of that is all out there. So I would suggest that's what you do. Let me back up and just say that what gamma is all about. Gamma is like the second order of delta. Delta being like the velocity or the direction of price. And the second order would be that the second order of direction would be velocity. And the velocity of price is really the difference between one directional move and the other. And so the second order would be looking at those two vectors, like a direction that's this big versus a direction that's this big. And so you have this difference, and then that slope or that direction, that is gamma. I know that's really a hard thing to visualize, but it's a lot easier when you actually look at a chart and say, oh, yeah, that's what he's talking about. And yeah, that's where we're at. And what we're looking to do in a gamma scalp is very similar to what we do with an out-of-the-money butterfly in the morning, but we're looking to do this later in the evening, taking advantage of a bigger difference, so the slope is bigger. And that's really what I want to. I know that this is, for those people that are listening to the podcast, that's not very visual, but in essence, your profit curve on your butterfly is constantly growing throughout the day as it fills up the butterfly. Now, a lot of people, when they're looking at something like Thinkorswim, may not really register exactly what that profit curve is. And what I'll do is I'm going to bring that in and just do a demonstration of exactly what that is so that everyone has an idea of what I'm talking about and where gamma scalping is going to come in. But ultimately, gamma scalping is, all right, let me see if I can get the presentation back up here. Gamma scalping is taking advantage of the steepness of your profit curve. The definition of gamma scalping, or gamma, is the sensitivity to price movement. So what does that really mean? It means that if I'm in a position, let's say a butterfly or any position, and price moves, say, 5 points, the sensitivity of the value of my position is going to depend on how steep that profit curve is. So as it's moving across 5 points, is the profit curve flat or is it very steep? If it's very flat, then the value of my position isn't going to trade or isn't going to change very much. But if it's very steep, then the value of my position is going to change a lot. And that's what I'm looking for. I'm looking to get into a position where I have a very steep profit curve. Now, earlier in the day, with a 0 DTE trade, the profit curve is still flat. It hasn't decayed enough to be able to fill up your position. And that's why a trade like this is better off waiting until later in the day when the decay has already occurred and you can take advantage of that steeper curve. We'll go through that and show how we're going to go about identifying a gamma scalp and what are the best conditions that we would look for to be able to execute that trade. As I said, for us, it's a edge case trade. We want to do it later in the day. You have a better opportunity to do it in lower volatility than higher volatility, so just keep that in mind. I have another presentation that might demonstrate that very nicely. I wanted to bring up the tool, but that's not ready yet. So I'm going to go back to a presentation I did a few weeks ago where I talked about the difference between high volatility and low volatility. And let's first look at our positions on a butterfly or any position. When you're looking at Thinkorswim or any other tool that's showing you a risk graph, it's typically showing you two things, which actually represent the same thing, but in different time frames. In Thinkorswim, you see this kind of cyan triangle when you have a butterfly. And when you have a vertical, it looks more like a parallelogram. But that triangle there is a risk graph, and it's showing you the amount of profit that you would have at different price points, the price points being along the x-axis, and then the amount of profit up and down. So you can see on the left I have 0, and then positive profit above 0 and negative profit below. So depending on where your position is, that would really determine how much profit you have. Now, I know that this is all kind of elementary stuff, but it's super important as we go forward. What you're looking at here is two different situations in terms of profitability. Yeah, there's my cursor. On the right is high volatility, on the left is low volatility. Let's assume that this is, say, noontime during the day. And right now we have relatively low volatility, so it's going to look more like the guy on the left where there's already advanced premium decay. In other words, your magenta line in your P&L or your risk graph is very bulbous and it looks like it's filled up your strategy. Well, what that represents is the premium decay. Now, an important thing to point out is the magenta line, that is your real-time P&L, and the cyan line, that is your at expiration P&L, represent the exact same strategy, but just at different times. The triangular thing that you're looking at with the butterfly, that cyan line, is your butterfly at expiration. So that's what your P&L is going to look like at the end of the day at 4 o'clock. The magenta line is the same exact strategy, but it's right now. And it is, as premium is decaying, it is growing and growing until it fits in and fills that at expiration, and it becomes that at 4 o'clock. So that's an important thing. Now, you can see that as it's growing and growing, that the slope of the real-time P&L is going to change. It's going to change from flat to something very steep. And if you remember, I said gamma is really the sensitivity to price. And that sensitivity to price is, in fact, that steepness of that real-time P&L. And that's going to be steeper at the end of the day. And that's what we're looking to capture. So now here's the thing, and the reason why I brought up the high volatility versus low volatility. In a high volatility environment, that premium decay has been slowed down. It's been delayed. And so on a 0 DTE day, you'll find that you'll get into, in the afternoon, say 1 o'clock, 2 o'clock, and your real-time P&L is still super, super flat. And you might be wondering, hey, what the hell's going on here? I've been inside of this butterfly and it's not really paying. And price is moving all over the place. What am I going to do? And that's a stark realization for a lot of retail traders that aren't familiar with doing 0 DTE trades in different volatility environments. That's the rate of decay that is pushing that reality, that it hasn't decayed yet. It hasn't released. And so let's go back another presentation that I was doing here and showing you that exactly what's happening. This is looking at the life of an options contract, a weekly options contract, as it's approaching 0 DTE, and each column represents a day in that life. And then the magenta line is the real-time P&L decaying, the decay rate. So in the beginning, it has 100% potential, and then over the course of each day, it starts decaying, and as it gets closer to the 0 DTE, that decay rate starts to increase. Now that's a very normalized view that I'm showing here. Actually, let's show you the true normalized view right here. So it's decaying, and as each day, 2 DTE, then 1 DTE, and 0 DTE, you can see the amount of decay starts increasing geometrically. And it's very clear to see here that on that very last day, the decay rate is really incredible. That's one of the reasons why we love 0 DTE, because we have all that premium to collect on that last day. Now, that's all dependent upon how much at that last day on what the level of the VIX is and what the level of it's the volatility level, because it's going to be different in high volatility versus low volatility. And so that's what this next slide is showing, is that in high volatility, it's pumping up the value of each individual butterfly or each individual contract so that the premium or the extrinsic value is getting more expensive. And the reason why it gets more expensive is that the market is looking at the movement, the relative movement of that butterfly and saying, oh, it's moving all over the place, and so there's a better chance that it's going to get into its intrinsic value, so we're going to pump up its value. Now, pumping up its value is, in essence, delaying the decay of that value, because ultimately on the 0 DTE day, at the end of the day, it's going to go to zero no matter what. Time is the final arbiter of premium decay. But in high volatility, that is held back, and it is building up inside of your positions. Now, in a butterfly, the way it manifests itself is as I showed you before, but that is the general thing that's happening. In high volatility, it's pumping up the value, and therefore on that last 0 DTE day, there's a lot more premium available, or a lot more potential. In low volatility, it's the exact opposite. It's sucking it out. It's just dragging it out. You've probably heard of volatility crush, when volatility finally gets relieved, maybe after an economic report has been released and there's no more anticipation, so vol drops a lot, and then the premium is just sucked right out of the options. So that's what happens in low volatility too, that on that last day you only have a little bit of volatility or a little bit of premium available to you, and that's why you have this big difference. So you can see here there's a huge difference in high volatility, how much premium is available on 0 DTE versus low volatility. You only have a little bit. Of course, this is the normal. Nothing's ever normal, is it? So that's the difference. And so that's why I want to then go to the butterfly, so you can see that as well, that if you look at the same exact butterfly midday, there's going to be one that in high volatility, it's still going to have a lot of premium or potential available to make money on it. And so the butterfly itself actually sits higher up on the risk graph, so that it gives you a much smaller risk and a much larger potential profit. Maybe if I go to this next slide here, it will show you that. The other thing that what we're all here for is that gamma, and the gamma is the sensitivity to price movement. Now, this little green arrow here is showing you an incremental amount of price movement. So let's say you move 10 points. Your P&L is going to all depend on where it falls on your magenta line, that real-time P&L. And in low volatility, it'll be very steep, because all of that premium has already decayed, and so the real-time P&L has almost filled the entire butterfly up. And so the change in value can be a lot, right? That big change in value is high gamma. And that's the key. It's high gamma. In high volatility, the change is very little, because that curve is very flat, right? And that's what we're really keying in on here. We want a steep curve so that small moves turn into big profits. Now, of course, if you're sitting right in the middle of a butterfly, that's not going to do you very good, because if you get a big move, then it drops off the curve. Although in high volatility, the drop's not going to be that big, so you have relative comfort. In low volatility, it's going to be big. But we don't do at the money. And see, that's opposite of the way the normal gamma scalper works. They work at the money. So a butterfly isn't going to work for them. So typically what they'll put on is a straddle. And a long straddle will look, let's see if I can actually draw it on the fly here. I wish I had my annotation tools. Let's see if I can grab them here. Presentation, presently. There it is. I was wondering where that thing was. So a straddle kind of looks like this, where you have a long put and a long call. And then this would be your profit curve that would look something like this. Right? Now, I've drawn it. It almost looks like an upside down butterfly. Now, this is your risk here. Now, I've drawn it way out of proportion. A real straddle would be much bigger, and that risk part would look much bigger. But the point is that what a trading desk or a institutional trader would do for gamma scalping is that they would put on a straddle and then sell against this profit curve here as it came in. So as the day would wear on, this profit curve would start moving down like this and getting steeper and steeper. Now, that's what they're relying on their gamma scalp and then betting against on either side, depending on which way the market goes. It's directional or non-directional. It doesn't matter. The problem is that the amount of profit that you get is really dependent upon how many trades that you make. And you're trying to scalp little bits of that each time the price moves against it. And that's a very difficult game to play if you have high commissions, which the trading desk doesn't, and a lot of money that you can scalp little bits over and over again. From a retail trader point of view, that is like the death knell. That is asking way too much to try to, first of all, get over the hump of slippage and commissions, which is taking away a good portion of that profit-making potential, and then doing it over and over again is really a recipe for disaster for a retail trader. And it's the reason why I would say, hey, look, when you look up gamma scalping online or whatever, and they show you the traditional trading desk way of doing it, it all makes sense in your head, but you don't realize that you don't have the same advantage of a trading desk. You're a retail trader, and it's going to eat you alive. You don't want to do that. So instead, we put on a butterfly that is very close to the money, but in order to get the kind of risk to reward that we want, let's say that right here is at the money. But we want to put it very close to at the money, and we want to have a small amount of risk and a large amount of potential profit like that. But also we want to have a really big real-time profit curve inside of there. So that means that we have to wait until later in the day when that has already set up and given us the best possible opportunity. Now, a trading desk isn't really looking at that. They're looking at making a little bit of profit early in the day, and as the day wears on and that gamma starts increasing for them, they can make more and more, assuming that price is going to move. But they don't care. As long as it moves something, they're going to scalp little bits and pieces. For a retail trader, that is absolutely the wrong way to go. You're never going to compete with them. You're never going to be able to make it worth your while to get enough. And if it doesn't, you have a huge amount of risk at the bottom of that straddle that's going to eat you alive. And the reason why I'm talking about this so much is that I had demonstrated my idea of a gamma scalp for a retail trader, and somebody had commented, "That's not how you do a gamma scalp." And they were referring to what you would normally do with a non-directional straddle and then doing it that way. But what I'm trying to impress upon you is that is almost impossible for a retail trader to actually pull off and make money. It sounds good, but when you start doing the math and then adding in the commissions and not having the kind of liquidity or capital in order to be able to pull it off, it just doesn't work. So what I'm offering is something much better and much more situational. It's not something you can do every day, but you could do it every day. It's just that the opportunity is going to change a bit depending on where volatility is. And it just works out more when there's low volatility because it gives you a wider window of opportunity. And that's probably something that you probably haven't noticed. When we get to the end of a trading day, or let's say on the second half of the trading day, say from 1:30 to 4, and we have low volatility. In low volatility, there's already been a lot of premium decay, as I've demonstrated in that previous slide, where I'm showing you how premium gets sucked out, and then from a butterfly point of view, it has the premium curve is very tall inside of that trade. So I'll show that again here. Now this could look like, let's just forget that this is high volatility. Let's just say that we're at the after 12 o'clock, or let's say it's 1:30, right? In low volatility, that premium curve is going to look like this. In other words, it's going to fill up most of the butterfly. There's going to be not much left. And if we put it out of the money, and we place our trade like this, we can get in really cheap. And if price does move towards our fly like this way, then we're going to make money. And that's the reason why is that it's a very steep profit curve, right? Now, in low volatility, that situation provides a much wider window. You can get that steep profit curve relatively early in the day, say from 1:30 all the way until the end of the day. In high volatility, it's suppressed because of the delay in premium decay. And so you might have to wait until 3 o'clock before you start getting a big enough profit curve or a steep enough profit curve in order to take advantage of that. And so that's the key. Now, the other thing is that we're not trying to do the omnidirectional plan. Our trade is definitely directional. We trade with the direction of the trend. But we try to set it up in such a way that will give us an advantage. And our win rate isn't going to be as high either. And you might think, wait a minute, you are trading direction, so can only make money if it goes towards it, and your win rate's going to be lower. How is that better? It's better because we don't have all the risk associated with a straddle where you can't make as much profit and you have a huge amount of risk associated with that trade, because with a straddle, you won't have the really neat risk to reward that you have with a butterfly, where you have a tiny little bit of risk on the debit and a large potential reward like this. With a straddle, it's going to look much, much different. It's almost like you flip the butterfly upside down, and it would look like this, and you would have a deep right at the money with the straddle. And if you do not get it quite right in the early part of the day, you could get stuck here. Or if price doesn't move enough to move towards the edges of your straddle, towards the put or towards the call, it's going to eat you alive. And it's a huge risk. And that's antithetical to everything that we do, in that we're trying to reduce our risk and maximize our profit. The other thing is we don't want to trade 10 times, 15 times, 20 times in a day. Maybe you do. I don't. At most, from a retail point of view, I'd like to trade maybe once, maybe 3 times tops, and then have really good risk to reward and good potential. And then I don't care if my win rate is low, because my return relative to the amount of risk that I'm going to put on is going to totally blow that away. So even with a 50% win rate, I'm betting so little that I just need a tiny little move to make a lot of money. And so that's what we're after. We're after late in the day when a lot of that premium decay's already done, and so your profit curve will be filling up your butterfly, and its slope would be really steep, so that when price comes towards it, if it does come towards it, it's going to make a lot of money. Now, typically, what does that mean? I'll give you an example. I've done trades where I've gotten into a butterfly trade late in the day, put on maybe a 20 or 25 wide butterfly, very close to the money, with costing me maybe 80 cents. So let's do the math on that. So the width of the butterfly is, say, 20, costs me 80 cents or 0.8. So we would divide 0.8 into 20, right? So that's somewhere around, 16 point something percent. 16, a risk to reward of 1 to 16. Maybe a little bit bigger than that. And that's a good deal. That's a really good deal. It's actually less than that. It's actually up around 20. So 2, let's see, we go into here, 2. We have 4 left over. And all right, so that's a 1 to 25 risk to reward. So that means that if price did end up going right into the center strike and then expired, I could make 25 times my money. Now think about that. That also means that if there's just a small move, I can benefit dramatically with just a small move. And I've put on trades like this and within a few minutes had a 10-point move towards my fly and turned an 80-cent or an $80 risk into maybe a $500, $600, $800 trade. Now, that's the kind of trade that I like. Now, I don't care if it goes the other way, because betting $80 to make $500 to $800 and doing that maybe 50% of the time is a good deal. I only have to be right, 1 out of 7 times to have a positive P&L on something like that. So I can be wrong. Now, of course, I'm not going to be wrong 7 out of 8 times because it's a 50-50 trade, essentially. And we can improve those odds even more by choosing exactly where we do this trade and when we do it. So we have a bunch of comments in here. I really appreciate that encouragement. Yeah, give this video a thumbs up because this is super important. I'm showing you a trade that you can put on super small money. You pick your spots and you can get like a 10-bagger very easily. Certainly get a 5-bagger. So that's what we're looking to do here. But it's not something, like I said, that you can do every day. And you want to understand the conditions when they're ripe to give you the best opportunity. And it's not about trading every day. It's about trading with the best risk-adjusted trade. So you want to have high returns on the risk that you put out. And if you choose your spots, you'll get that. Your drawdowns will be small, your profits will be large, and that will turn into consistent profitability. So one of the things that we can do to improve our chances here is, first of all, favor low volatility environments like today. The other is that we can wait for the trade later in the day and see if we can get to a point where there's a structural level where we can place that trade. So that'll require me to go over to TradingView, and we'll talk about that a little bit. Need to turn this off first. TradingView. Man, we're going straight up, huh? That's incredible. So VIX is low, or relatively low, at around 20. I expect that it will probably continue to drop if we continue to go up. And that is producing the kind of environment that we like. That is accelerated premium decay, which would turn into higher gamma. And again, this is a gamma scalp. We want gamma to increase, and gamma increases when volatility drops. Let's see, the next thing that we want is structure. Oh, I get rid of all of my structure. Oh, there they are. There's my structural lines. So let's take a look at yesterday, for example. So this is yesterday. And we were looking for trades. If you remember yesterday morning, I said that we were looking for a pullback into one of these structural levels. The market went up, then pulled back, and I thought it could move into one of these structural levels. And if you go back to yesterday's, you'll see I drew these arrows yesterday. But let's take a look at this from a gamma scalping point of view. And we'll draw our session lines in here. It's 2:30. And then here's the end of the day at 4. All right. Now here's a perfect opportunity right here, right on that structural level here. So we're very late in the day here. It is, at this time, it's about 3:30 or so. Actually, it starts right around 3:30. All right. It also happened over here, right here at about 2:35. So in an environment like this with the VIX right around 19 or 20, you're going to find that your opportunity is going to be about from 2:30 to 4. If we were in much lower volatility, if the VIX was, say, around 17 or 18, that window would open up maybe as early as 1:30. And that's, again, because of that advanced premium decay. But for yesterday's trade, this would have been perfect. There would have been 2 opportunities. One right here where it dropped down to structure and then popped up. And you can see it popped up fairly quickly in 3 successive bars. I'm going to expand this a little bit. And I know that if you're on a podcast listening to my voice that you can't see it, but trust me, it's there. There's a level at 71.38 or so that is a structural level. Price moved down to it. Now imagine we're later in the day and our butterfly will look something like, here, I got to get that tool back up. For some reason, it keeps on going away. I'll show you what our butterfly would look like relative to this. Our butterfly would be up here somewhere, right? We would actually get into it. The left side of the butterfly, that would be where we would enter. And then the center strike might be up here, and then the other long strike would be here. So what happens here is that price hits structural level. We might put a 20 wide fly and pay, let's say, 80 cents for it. And then in, let's see, 5, 10, 15 minutes, it moves up. How much is that move there? From 71.38 to about 10 points. A 10-point move in a trade like that is going to produce probably maybe $250 of profit for an $80 risk. And that's exactly what you would have achieved there. And it's all because that butterfly would have looked something like this, where right here would be where you entered, that's at the money. And then your profit curve would have looked something like this. And that move into there would have resulted in profit right here, which I'm just guessing, but based on my experience, probably would have been about $250. And so that's what you're looking for. You're looking for that steep curve right there, which you're going to get in low volatility. I hope that makes sense to you all. Now, in a high volatility environment, this curve would not be so steep. It might look maybe more like this. And you'd have to wait until later in the day before it looks like this, the steep version. And you can see on this Thinkorswim butterfly that I drew here, it's relatively flat. Later in the day, the premium or the at the money position is going to be like right about here, maybe 20 points outside of the fly. And the profit curve is going to be much steeper as it decays over that period of time. Here at 10 o'clock, it's really flat. But later in the day, it's going to decay and be very steep, and that's going to be our opportunity. And so a small move towards it is going to result in a lot of profit. You can see the amount of risk that I'm taking is going to be relatively small compared to the potential. And so that's what we're looking at. I'm going to have my presentation all set up for tomorrow. For whatever reason, it didn't get out today. You can use a trading view drawing tool. Oh, that's a good idea. All right. So a trading view drawing tool. So let's say that I put my butterfly up here. And then I set up my trade such that I have a structural level on one side and I'm going with the trend. So that means that I'm looking for a move like this. So we had one move there, and then we had another move here, which was even a better move. And this is exactly the situation that you're looking for. You have relatively low volatility later in the day. This side of your trade would represent when you actually get into the trade, which would be right about there. And then later you would get into it right about here. But a trade like this, you could definitely put it on for cheap money yesterday. At this time of the day, maybe around 2:30, it probably would have cost you a little bit more, maybe $1.50 or something like that. And a move of 10 points there probably would have resulted in maybe $100 of profit. But the later day trade here, you definitely could have gotten into that trade for 80 cents, maybe less. And then that move would have resulted in, I'm going to guess and say $300. But that's the kind of situation you're looking for. I'm going to see if I can pull off a trade like that today and see if we can demonstrate that tomorrow. But that is really what you're looking for. And the reason why I'm showing later in the day as opposed to one of these moves over here earlier is that the premium hasn't really decayed enough in order for me to get the kind of price and get close enough to at the money in order to take advantage of it. So thanks for the suggestion. Definitely not totally prepared today for this one. Let's go to the big head. Yeah, my presentation came late. It's there. We'll do this again tomorrow, and hopefully I'll have an actual live demonstration or a demonstration that I can show you, and then show you the difference of price from one time to the next. Let me just give you some rules around this. First of all, a gamma scalp our way is still looking for extreme asymmetry. Very small risk, large potential profit. That's the first step. The second step is looking for what time of day we're going to get that extreme asymmetry. In low volatility, that's going to happen a little bit earlier in the day. So let's say that when you're down around a VIX of 17 or lower, you're going to find you're going to have a window of about from 1:30 to 4 o'clock to make this trade, and you might have several opportunities. If the volatility is up around 25, now your window has squeezed down to about 3 o'clock to 4 o'clock. So you can see there's a big difference in the amount of window of opportunity that you have based on the amount of VIX or the level of volatility, which will determine the rate of decay, which will determine whether or not you can take advantage of that high gamma or that steep profit curve. So looking for lower volatility and getting an extreme asymmetric trade. And then the third element is if you can get all of those things and then wait for a structural move into structure and then put on the trade. Now you have a backstop with structure. So the chance of it going towards your fly have increased dramatically, or at the very least have not moved away from structure and gone the other way. I would still say that there's probably a 50-50 shot, but the odds are that it's going to move up off of that structure into your strategy. So those are the three elements that you're looking for. Lower volatility and or that extreme asymmetry, and then back it up with structure, place the trade, wait for that sharp move off of structure, and then be quick to take the profit. I found that those profits can come in anywhere between 5 and 15 minutes. Sometimes it might even move into the center strike of your, that's happened to me before, where you put on a trade like this and it does move into your butterfly. It doesn't have to move very far, but now you put on a trade for, let's say, a 1 to 25 risk to reward, and you could have a trade you paid $80 for and it turns out to be worth $1,500, $2,000. I'm not guaranteeing that, and I'm just saying that's outside the average type of trade, but it's certainly possible. What is very possible is that you can get a 2x, 5x, 7x trade with this type of strategy under the right conditions, and that's certainly worth it. It doesn't take too many opportunities if you set it up correctly to really bank it. All right. That's what I wanted to tell you. Tomorrow I will have the presentation and we'll go over very specific examples, show you exactly how you can execute this trade. In the meantime, please give this presentation a thumbs up. Thank you very much. This is Coach Ernie. Peace out to you. Have a great day.